Hello fellow traders. This session treats 2025 like a wild trading season, and we're going to go over the post game, where subscriber ideas are reviewed like game tape. The focus is on understanding how traders start in real time, not just tallying wins and losses. Think of this like watching a highlight reel from a season, except the players are charts and ideas. The goal is not to roast anyone, but dissect what actually happened in the market versus what we expected. We will use Tesla as our blue chip example, and we'll look at another meme stock as our chaos example, because nothing reveals trading discipline like a chart that goes straight up and down. By the end, the goal is that your 2026 ideas feels less like YOLOs and more like plays drawn up on a whiteboard. So today we're going to get into subscriber type charts and ideas for 2025. Let's get into it. What 2025 felt like for traders. The 2025 environment was defined by small and strong participation, frequent bursts of volatility, persistent dip buying that helped drive markets to new highs after pullbacks. At the same time, traders increasingly favored ETFs, options, and concentrated thematic plays, especially around AI, shaping types of setups that appeared in many subscriber charts. Before we judge any individual trade, we need to remember what the weather was like in 2025. Retail investors stayed very active and helped push stocks toward new highs after almost every scare, stepping in aggressively to buy dips when volatility fired up. This was not a calm trend. It was more like a stair step higher with regular burst of drama. And on top of that, a lot of money rotated into ETFs and thematic products, especially AI-related baskets, while single name speculation concentrated on smaller groups of names. That backdrop heavily influenced charts and ideas that showed up in the submissions whiteboard. How we judge subscriber ideas. Each trade is evaluated primarily on the process rather than the raw profit and loss, emphasizing clarity of entry, thesis, and risk. Strong ideas identify key technical levels and fundamental drivers that define where the trade is undervaluated or invalidated. Timing and awareness of the catalyst, earnings, macro events, or sector flows are treated as part of the edge, not background noise. The scoreboard is not P&L, it's a process. A trade that made money that was based on hope and FOMO is far less impressive than a well-planned idea that happened to get clipped. A strong idea tells you exactly where to enter, what the thesis is, technical, fundamental, or both, and where the trade went wrong. If the price hits that level, you're out, no arguments. Timing matters too. Placing a trade into earnings, macro lease, or sector rotation changes the risk profile. As we go through Tesla and memes and ETFs, keep asking, was there a real plan here, or is it just a pretty screenshot? Tesla in 2025, year of expectations. Tesla in 2025 remained a volatile magnet with a blend of cult-like retail interest and heavy institutional attention. The stock posted a solid up year overall, but with sizable swings, including a pullback of roughly 8% from the mid-December peak, as sentiment and news flow shifted. The price action reflected constant repricing of narratives around EV demand, AI, and robotaxis filtered through changing macro conditions. Tesla is one of those names that never seems to leave center stage. In 2025, it finished the year in respectable shape, but the path was anything but smooth. Stock pushed up into the year end, then backed off around 8% from mid-December peak as the market reassessed earnings, macro risk, and the pace of Tesla's grand promises. Themes like EV adoption, AI, self-driving robotaxis all played into how traders and investors priced the stock. For active traders, that meant a steady stream of opportunities if they had framework for dealing with volatility. Subscriber case study. Breakout play. One subscriber identified a classic breakout setup, Tesla, as the price compressed under horizontal resistance zones. The plan was to enter a confirmed close above the resistance with increased volume, set a stop below the breakout zone to define risk, and target a prior 2025 swing, creating a clear risk structure. This approach treated Tesla's volatility as an advantage, not a threat, but paired it with strict level based rules. This Tesla example is what happens when you combine a volatile name with a calm strategy. The trader noticed price knocking on the same resistance band multiple times and finally breaking through on strong volume, which is the classic breakout rule. The entry trigger was not it looks good intraday, but confirmed closed above the zone. The stop lived just below the band, so if Tesla slipped back in the range, the thesis was we're starting a new leg higher and would be considered wrong. For the upside, they picked the prior 2025 swing high, not a fancy price, giving it trade clean risk-reward profiles. This is how you trade a wild ticker with a disciplined plan. What happened to the Tesla breakout? Trader that jumped into this and saw the potential of what it could do. So, at the beginning of the year, you had a sell-off here. You can look and see it's not really major volume when it sold off at 427, but then made a run up again at 431, and then corrected pretty much all the way down to 200. Looks like it was right after earnings. So the trader that saw the inside of it heading back up pretty much validated it with the chart volume going up. So when it ran from 222 to 275, it roughly traded about 219 million in volume, and then just from there, the steady run up from March all the way up to pretty much the end of 2025, and from that point you figure it's $200, so that trader made out really good. And having the foresight to understand where the bottom is important. So it looks like when that thing bottomed out, it sold off with about 181 million in volume to 212, and then volume buying picked back up at 222 with about 219 million in volume heading back up. Tesla respected the breakout, moved higher, validating the trader's entry and target logic. Later, the stock encountered turbulence from the news and macro factors, reversing its mid-December high and falling around 8% from that point. Traders who scaled out into strength or obeyed trailing stops retained gains, while those who held rigidly without an exit strategy watched much of their unrealized profit evaporate. At first, the trade looked like it was going to be straight into the textbook. Tesla broke out, pushed higher, and gave the trader exactly what they were looking for: confirmation that the resistance had turned into support. But then, as often happens, strong narrative names, the story shifted. Macro noise, stock speculation news knocked the stock back, and it dropped back roughly 8% from the mid-December high. Traders who took partial profits near the high and tightened stops as the price extended were able to walk away with a solid win. Traders who assumed that Tesla would just grind higher never took anything off the table, and they just did not take the risk watched as a big chunk of their paper basically shrunk their gains. In the same setup, the same stock, different risk discipline. Lessons from trading narrative giants. Stocks like Tesla, driven by powerful narratives, can produce extended trends that also are violent reversals, making them both rewarding and dangerous. Technical levels such as prior highs, gaps, volume clusters can act as these key decision zones, but sit in a swirl of headlines and sentiment. Scaling into strength, taking partial profits near these levels often works better than an all or nothing approach when dealing with such volatility. Tesla's chart is what you get when a narrative and price collide. Strong stories create beautiful multi-week trends and then sometimes flip overnight with new headlines. Technical levels, prior highs, gaps, and volume shelves are not just magic. There where a tug of war between the bulls and the bears intensifies. Instead of thinking, I'm all in or out, a smart plan in these names would be to scale. Add on orderly pullbacks within the trend and peel off size near obvious resistance zones. This way you respect the power of the narrative, but also respect how quickly the narrative can be repriced when reality intrudes. A meme case stock study. GameStop redo. Over the GameStop example, real time, and try to drive home the point about, especially following volume. So when this thing sold off with about 172 in volume back in June, it pretty much hit 23.57 and sold all the way off to about 21. Yeah, it's a couple dollars, but the volume's important. So from that point, it traded less than that volume and pretty much was range bound from 24 to about 21. And then we had another volume sell that took place in September when it hit 25.21. Came in with about 40 million in sell-off volume, and it slowly trended up because there was an announcement of Bitcoin holdings. And then once it hit 28.03 in November, well actually October, it sold all the way off to about $19. And since then it's been range bound between 23 and about $19, continuing to fade on lower volume. But that's why it's important to pay attention to, especially huge sell-off, because then that tells me that it's reaching a point of no return, and very rarely does it get back when it sells off over 100 million in sell-off volume. GameStop remained a recurring meme stock in 2025, surging back into focus whatever new stories such as moves involving Bitcoin into its treasury or a perceived crypto pivot captured attention. These catalysts triggered a classic meme behavior, abrupt vertical spikes followed by sharp meme reverting drops as hype faded and price drifted closer to the underlying value. GameStop kept coming back like a sequel nobody ever ordered or watched. Whenever there's something like a storyline worthy thing hit, especially around Bitcoin and crypto associations, the stock returned and volume exploded. On the chart, for those moments show up all of a sudden as tall green candles that look almost unnatural compared to the normal price action. Then just as quickly, gravity kicks in and the spike slips back to the more realistic levels. For traders, this is either opportunities or traps, depending entirely on how early they were and how clear their plan was. Meme lessons in the 2026 game plan. The full journey from Tesla breakouts to game style spike memes, spikes to ETFs and AI trend plays point to one central truth. Narratives can amplify both gains and losses, but process determines which side you're on and where you end up most often. Meme names in 2025 showed how less planned entries and the vertical moves often justified by diamond hand culture could quickly turn into painful drawdowns as spreads, slippage, and mean reversion took over. In contrast, many of the strongest subscriber results came from the structured setups like Tesla and ETFs and AI-themed products, where traders define entry stops, targets, and realistic time frames, and then let trends do the heavy lifting. The big upgrade for 2026 is to convert isolated chart screenshots into consistent playbooks, categorizing setups, matching position size, and holding period to each pattern, and journaling both mechanics and emotions so a heavy trade becomes fuel for improvement. The real edge is going forward and not finding the next viral ticker, but applying the risk-aware, repeatable process across narrative stocks, meme names, and boring ETFs alike, so that next year's charts tell you the story of deliberate decisions instead of lucky breaks. Put all the pieces on the screen. On one side, you have the meme names like GameStop in 2025, vertical spikes sparked by fresh narratives over Bitcoin-related headlines, then gravity and mean reversion stepping in just as hard. Late buyers without stops, time limits, learn the hard way that diamond hands is not a risk strategy. On the other side, you have disciplined setups in Tesla, ETFs or AI-themed funds, where traders predefine entries, stops, targets, and allow trends and flows to work for them instead of fighting every tick. The upgrade for 2026 is to stop treating charts as one-off screenshots and start treating them as plays of the system. Tag each setup, breakout, pullback, reversal, or meme scout, so you know how to size it and how long to hold it. Journal the thesis, the levels, the results, and yes, even how you felt, because your emotions are part of the data. Narratives will keep changing, and Tesla will have new stories, new memes will appear, and new themes like AI or crypto will rotate through the spotlight. Your edge is not predicting the story and which one comes next. It's about having consistent, risk-aware processes ready, so your charts look less like lottery tickets and more like a professional playbook. And thanks again for tuning in.